Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Good afternoon and welcome to the AICPA Town Hall. I'm Eric Auskerson, one of your hosts for today. We've got a very dynamic session for you. As we try to do here on the Town Halls is bring you the latest information, and we've got a lot of breaking news related to the legislative activities in Washington, D.C. So once again, if you're new to the Town Hall, what we try to do is to interpret what's going on in the capital markets and down in DC and with the firms and members in public and industry, and bring you guidance and recommendations that you can review with your clients. If you are new to the Town Hall, there is a materials button on the lower side of this webinar panel. You can click on that, and there's instructions related to CPE and other items. So please do leverage that. What we're going to be covering today is we're going to open things up with a legislative and profession update, which Barry Melanson is going to join me for. And then we're going to bring in a leading practitioner to really talk about what you should be discussing with your clients with all of this uncertainty in the marketplace due to this massive legislative activity. And then Lisa Simpson's going to come in and give you some really good tips related to the PPP and ERC interplay. So what I'd like to do now is bring Barry Melanson up, who you all know, the leader at the AICPA. And Barry, as we'd like to say sometimes, we could be in a sprint week or a marathon month, but what we're really in right now is a furious 24 hours related to what's going on in Washington, D.C. So we've got some road signs here, and where are we? Where are we in the process with the infrastructure and reconciliation bills?
Well, we're literally at the intersection because there's a lot of activity that's taking place as we speak, as this program is live, Eric. It's always good to be with you and all of our members who are on this town hall and the series, which is fantastic. And last week, of course, you had a special town hall that was just focused on some of these legislative issues. Where we are right now is the Senate has just recently, in the last hour or so, passed a continuing resolution to keep the government funded. That is now in the House. We expect that to pass. It could be passing as we speak. And that sort of keeps the government funding, averts the shutdown. But the big issue today, or maybe the biggest issue today, they're all big issues, is whether or not the infrastructure bill first will be voted on. It looks like it will be voted on. And then will it pass in the House of Representatives? I think it's really important to understand sort of some behind the scenes things. It doesn't make headline news on our television channels and things of that nature that we see at night when cooperation is actually the message. But there's one of the things, if you're in Washington a lot, you really understand is that there's a lot more bipartisanship than what gets reported. I'm not saying there's as much as there were maybe a couple decades ago, but there's still some bipartisanship that actually takes place. And the infrastructure bill is an example of that. There's a lot of work that's going back and forth to see if that can get passed. Moderates on both Republican and Democratic side really working on that. The real element of this is that Speaker Pelosi, in working with the moderates, promised a vote by today on the infrastructure bill as a standalone piece. The progressives in the Democratic Party want what's called the dual track, that there would be a vote on the infrastructure bill and the reconciliation package so that they know all the tax provisions and all the funding mechanisms that will be in place. That dual track is not really going to be the option, and Speaker Pelosi really has the choice of living up to that commitment of having the vote today and risk it failing on the floor or actually delaying it. It looks like, and she has said today, that she is going to bring it to a vote imminently, keep the voting open probably, where there's going to be a lot of time to try to convince people to be able to get the right votes. And what's really happening is the progressive side of the Democratic Party hasn't said that they're going to vote for it. In fact, they've implied they may not vote for it because they want this reconciliation bill to be linked, and that's not going to happen. The speaker is not linking it. And then if they vote against it, then the package fails, the infrastructure fails. For now, the media may call it dead tonight, but it won't be dead. There will be other opportunities for that to come forward. And likely we still believe that it will get passed, even if it doesn't pass tonight. And the moderates and maybe some Republicans will join together to pass the infrastructure bill if it does pass in the House tonight. And so there's a lot of uncertainty on that, but it all revolves around ultimately infrastructure and reconciliation, which is where the tax elements come to. And of course, as I said, we covered that in the town hall last week. And there's a lot of uncertainty on that because that's really going to be the Senate that's going to drive it. And two key players in that are Senators Sinema and Manchin, Arizona and West Virginia, who have been very vocal about how much they will support, where they will go. There's a lot of behind the scenes discussions as to what those compromises might be, particularly with Senator Manchin. And they're actually working across the Capitol into the House to some degree, particularly Senator Sinema, who was in the House, and trying to sort of have that cooperative work that would give us some answers. Of course, some people don't want those answers, and so that is a big part of the process as well.
Well, Barry, I mean, it's clearly we need more than road signs here. There's a lot of twists and turns that are going to occur as you know. Pelosi says, we're gonna vote for the bill tonight until she says we're not going to vote for the bill tonight.
That's right.
To be determined. So when you look at this, maybe just a little bit more discussion on, it's hard to predict the future, especially when you're talking about Washington, D.C. But and you did a little bit of that predicting, but maybe, kind of unpack it a little further and maybe give two or three scenarios that our D.C. team is working hard on understanding. Right.
So if sort of either whether she brings the vote or it passes or fails, we still believe that is very much still alive. Our best guess, and look, it's very unpredictable and it could change. And if we have a town hall next week or in 2 weeks, we could give you a different message. But we're thinking that towards the end of October, it could slide into November. It sort of depends on how definitive Senators Sinema and Manchin are on what it will take for them to support reconciliation in the Senate. We still think the best assumption is to believe that these packaging of reconciliation, ultimately debt extension, I haven't even talked about that yet, and continuing funding in the government, along with the infrastructure bill, those four elements gets passed around the end of October, the beginning of November. It will not probably look exactly like it looks now. And really, what's happening in the Senate on reconciliation, which is the details, if you will, of the tax ramifications, that language is not even out. That's being handled by the leadership. So when people say they know what's in the bill, we really don't know all what's in the bill. We have some ideas based, and we'll talk about that in a minute, but we have some ideas based on what's in the House bill, but the Senate will be absolutely critical as to whether and what passes in this environment. She could delay still, as you said, Eric. That probably puts it, more into an unsettled situation because the moderates will feel like her commitment to them probably wasn't lived up to. So, it's really going to be interesting to see how it plays out. I guess I would say the most important thing to take away from this is that if the vote occurs, which again, it looks like it will, on infrastructure, and if it fails, and if you read or hear that means it's dead, I would dismiss that particular point. I think there's miles to go before we sleep, and that's going to take place in all of October, and it won't be dead at that particular point. And Senators Sinema and Manchin working on specific provisions and trade-offs to keep the group together, I think is the moderates on the bill, I think is going to be very important.
Okay, Barry. So, I mean, just to help summarize a little bit, you did a nice job there. I mean, progress is being made. There's probably more bipartisanship going on and discussions occurring than we're hearing in the media. And it still looks like something will happen, but it might look like nothing will get done before something does occur in the end. So with that,
if it passes tonight, there's deals that have been cut that actually make that happen. That's why she's leaving the vote open.
Well, Barry, let's just talk a little bit about. I mean, this is probably some of the most important elements for the attendees on the town hall. Some of the knowns that which could change. What some of the House tax proposals that have been put into that have been suggested for the reconciliation bill. You still need the Senate version, and then there's some items in play here. Some of these items are from Finance Senate Chair Wyden, so they're pretty material suggestions that are in play. So when you look at why don't you break down what you see here on this slide?
Yeah, so the top half of this slide are things that are in the House tax proposals that we believe likely something very close to this will be what would come out of the Senate process. Now, a couple of key points here. Our position historically and certainly today has always been about when you have rate changes and you have different law changes, that it's always best, it's least complicated to make those changes occur, at the beginning of the calendar year, January 1 effective dates. Most of these items, as it's working its way through the House, is actually targeted for January 1 type of activities. The capital gain increase has a placeholder date in the House version of September 13th. Transactions before or after September 13th, after would be subject to the new rate. That date could change as the Senate writes their legislation, as the timing extends to the end of October. There could be pressures to change that date to a later date, not an earlier date, but to a later date in that process. The rest of these items, there's one other small item that would have a different date, but the bulk of these items are targeted to be at that January 1 timeframe. The other thing that I would just say, even though these are likely, and this is in the House wording, there is some discussions that happened overnight that has a different capital gains rate as some of the discussions of Senator Manchin's thinking and things of that nature comes into play. So you're going to see some elements here. The bottom half are items that are more uncertain. So state and local tax deduction, that's a big issue in many of the high state tax states. And there's likely going to be some kind of compromise on that. Not likely a full restoration of SALT deductions, or if it is a full restoration of SALT deductions, it would be for a limited period of time, most likely a cap adjustment. There is the potential for some very complicated partnership changes that are being discussed in the Senate. Subchapter K changes that get very, very complicated. There's a package of things. Subchapter K, all of the tax practitioners know, has tentacles throughout the law. And when you change one thing, there's a lot of uncertainty as to whether you're getting everything right in the tax law. But there is clearly some serious discussion about changes in the partnership tax structure. There's a potential for regulation of paid tax preparers to be put in at sort of the last minute in the Senate. There are some things we support in that. There's some things that we're concerned about in that. And so, again, with the language not being written in committee, some of these things are going to have less of ability for us to, or others to be able to really influence them. And there's a whole host of other things, some of the deferred compensation changes and the like, that are in serious debate, but they are not necessarily at a refined point that we can predict the exact outcomes at this particular time.
Well, Barry, at this point, I mean, thank you, but let's bring up Tim Spies, who's the co-lead of personal wealth at EisnerAmper, a top 100 firm that is very well known with the profession. And you and I, we can drop the slide and just go. We're gonna have a little bit of a discussion here on, how do you think about this, for your clients, or give advice to other members of your firm. So welcome, Tim.
Thank you.
I'm gonna, and Tim is somebody who speaks frequently to other media outlets, the Wall Street Journal and CNBC. So it's great to have you with us. And when you just heard Barry talk about some of the knowns and some of the unknowns, How do you manage this ambiguity? I know in a pre-discussion with you, you talked about the client calls that were coming in. So how are you thinking through this for your clients?
Well, first, good afternoon, and I welcome our audience, and certainly know as we're now in the fourth quarter or approaching the fourth quarter, this is going to become very important. Yes, we are seeing a lot of areas. I have 4 items specifically to cite. First, in the trust and estate arena, many of our clients are business owners. They think about family members in the business. They think about transferring at the time of passing or before. They think about sales to family members during lifetime. All of these things are real discussions, and there's provisions in the legislation that would meaningfully impact any of those decisions and considerations. First, the federal exclusion is poised to be reduced to $5 million. So that's something to think about. Clearly, as again, we're in these discussions. Grantor trusts deserve a very, very careful look, because those are very much in the eyes of the IRS, what they would like to see as entities that would not exist going forward. And so there's provisions there. Probably time doesn't allow to go through grantor trusts. Many of you know how they work and so forth. But there's prohibitions with respect to how it could cease to be a grantor trust. We all know that income flows through to a grantor trust. The big thing there is the ability or prohibition on sales to grantor trusts and transfers to grantor trusts. And so therefore, looking at those vehicles, looking at comparable vehicles such as partnerships, limited discounts, voting and non-voting, should be something that would be undertaken. And then while we're at it, in the arena of estate planning and these types of vehicles, thinking about CRUTs, GRATs, private annuities that could be established where a trust could purchase an asset in today's very, very low interest rates and arbitrage the rate of appreciation where the asset is moved inside of a trust. Let's say it's a non-grantor trust, for example, and therefore that appreciation well in excess and out of the estate when it's removed in the way that I've described. And that could also be done with an installment note. Again, very favorable interest rates. So using structures like this, and I would say further in my comments that with this legislation, if enacted, non-business transactions will have a heightened level of scrutiny by Treasury. Our advice is that try to have a business purpose element in any of these transactions I just described. They still exist. They still have tremendous value, but you're going to want to make sure that you do have a business purpose. And those were basically the 4 points. And I'll go back over this as well, maybe in a moment or so. I next want to go to what's happening in the other key elements of the code and in taxation. And there's really 7 items I want to point out here. The first is the increase in the federal income tax for individuals. You've seen it going from 37 to 39.6. That's for a married joint couple. The ability to make gifts, bona fide gifts, transactions amongst family members in a bona fide way, similar to what I just described before, where we're able to use the Internal Revenue Code and this legislation to transfer assets to persons in lower income tax brackets. You can do it with bona fide sales. I mentioned a couple of examples. You're going to see also a potential surcharge of a 3% income tax if the law comes to pass, and a very much expanded net investment income tax provision. It would be imposed on single persons at $400,000, married filing jointly at $500,000, and then married filing separately at $250,000. So that's something we're all familiar with, the net investment income tax, and that is poised to continue, but now with with rate differentials. The qualified business deduction. Many of you have helped your clients utilize that deduction. What we have to be aware of there is that will now have a potential limit on a go-forward basis. The deduction limited to $500,000 for a joint couple, $250,000 for a single person, and there's additional rules that would come into play here, but the QBI deduction will continue. It's going to have additional limitations, however. And by the way, I could say if anyone wants to either tell me to move along and go faster, I can. So I don't want to take up the time of any of the subsequent speakers. Long-term capital gains, 20% going to 25%. There's a transition rule, though, that you'll be able to take advantage of where transfers were occurring pre-September 13, 21. I should also point out, and I think it was mentioned by Eric or Barry, a lot of these provisions don't have effective dates yet. It hasn't been cited. Will they be effective within this calendar year? There's been some firm dates cited at 9/13. There's also been dates or potentially where it's going to be effective 12/31 post, meaning 2022. So we do pay attention to the effective dates. And if I went back to the very beginning, and I just have a couple more remarks, but if I went back to the very beginning, as we're learning about the legislation, educating our clients on their opportunities from a family perspective, business, investment asset perspective, because a lot of these dates are moving dates. I would highly recommend estate planning, in my opinion, should be at the top of the list, not only for your clients, but for yourselves, because there's going to be changes there. And there's still time, and the use of things such as grantor trusts and other vehicles that potentially could be struck from existence by the proposed legislation is very real. The last things I'm going to mention, some of you deal with this on a regular basis, an overhaul of the partnership regime, the GILTI provisions, the bank reporting deposit, which I think some of you might know about, that there's now proposals to have a universal bank reportings on deposits, and the threshold could be as low as $600. What will Treasury do with that information? We do not know, but certainly you want to be aware of that. And then a minimum alternative minimum tax of 15%. So that could also be in the legislation as well. So with that, we'll keep going, and I thank everyone for your attention.
Yeah, well, Tim, thank you for that kind of next level down of analysis of what potentially could happen here. And Barry, bring you into this, but just maybe kind of more of a back and forth now. So that's a lot of different factors to take into play. You know, the importance of the estate planning. But so just any other more trusted advisor type of guidance. You and I had that discussion on when the clients are coming in and just saying, should I sell now? Should I wait? How do you just, without getting into maybe the technical details, how are you managing that discussion?
That was to you, Tim.
Oh, sorry. These are very sensitive discussions. And sometimes what we as advisors might think is somewhat straightforward, I'm certain many of you have just encountered situations where your client are not necessarily possessing the enthusiasm you have as the advisor for them to do something. But everything that was just stated is true. I mentioned earlier capital gain transactions. I've mentioned estate planning. These are all very appropriate to be talking about now, even if legislation doesn't happen. I mean, these are just good discussions to have. And Barry said this in his opening remarks. Although we're getting close to something called certainty, to maybe know how all the provisions are going to pan out and be included in the legislation, we really don't know. And these effective dates could move. So again, my view is talking to clients, advising them on opportunities now, letting them know what some of the risks are with new legislation that could perhaps prohibit some very, very valuable tax planning between now and say, the end of the year.
Eric, I think one of the key components that Tim raises, and a lot of a lot of clients are asking the questions because the capital gains rate and the higher marginal rate is the highlight. It's a lot deeper than that, and really the more comprehensive discussion is I think where to go, because each individual taxpayer is obviously unique depending on where they are and their own, if they're a small business owner, succession, value of those types of things, estate actually comes into play. And I think Tim is right. The estate provisions that are set to expire in 2025, they're going to get truncated down. I would just add on the $600 reporting from the banks. That's probably one of the more controversial issues. There's a lot of controversial issues, but it's one of the most controversial. I think we think that if something is enacted there, it'll be at a much higher threshold than 600. Is it going to be 10,000 or something along those lines? But it's going to be at a much higher threshold. And clearly that's an information flow. The banking community is very active on that environment, but that does sort of get to the tax avoidance aspect. And in the reconciliation bill, there is funding for the IRS, which to enhance enforcement and other things, and hopefully service levels, et cetera. That remains to be seen. We've talked about that in previous town halls, the service level problems that exist. But the fact of the matter is that the funding will obviously be focused in the higher income, more complex tax return areas. Some of these transfer of property issues, et cetera, because it is based on funding equals more tax collections. That's how it's being sold. Big numbers there, like $1 trillion, and so. That is a big element in this complex world of the higher income clients that you have, to really use that as an attention point for them. Tim talks about clients don't always want to have the same energy about some of these things, or we can do them later, or, what's the big deal? I think that funding of the IRS for that purpose is a talking point that I think can be very effective there.
Yeah, Barry, that's a good segue. We got a couple of other items that we want to cover here. So why don't we and Tim, we're going to bring you back for the open forum. I've been looking here. We got a lot of good questions following up some of the additional points that you made. So Tim, thanks for having you. We'll have you back at open forum at the end.
Thank you.
So Barry, we got a couple of slides here we want to cover before Lisa joins us and talks about ERC and PPP interplay. So this year, you were just talking about the funding for all of this. I know this is a pretty important initiative.
Yeah, so there's sort of three parts here. Two are happening in like a lot of profile, and one that's a subtext that we've been pushing. One is, as I mentioned at the top, there's going to be a resolution that's passing both houses and go to the president today, that funds the government and extends that funding out into December, likely December 3rd. And so the shutdown part is being averted. There's a lot of moderates. There's more moderates than you think. There are some maybe marginal moderates, but they're in tough districts for re-election. And that caused a lot of consternation. And the other piece of that is the extension of the debt limits. And so far, there is no deal to pass the higher debt limits. That's sort of being held hostage in some of these negotiations. But in passing the funding of the government, I think there's a lot of people in Congress that want to demonstrate that they do have some fiscal responsibility. And we have been pushing for a long time a joint resolution of the House and the Senate that would require the members of the Senate through a mechanism of the budget committees to receive in a more formal way and to hear in a more formal way the results of the audited financial statement of the federal government each year. All of this that we talk about, the trillions, the spending, the budget deficits, are all cash basis. But there is an accrual basis financial statement audited by the Comptroller General, who will be a speaker at one of our meetings coming up in October, and the Government Accountability Office, the GAO, that audits the financial statements. It's usually issued in December sometime. And our belief is that Congress, and we have something called the fiscal state of the nation activity, and what we call what's at stake, is an information set that we go to the members of Congress each year and their staffs to try to get them focusing on the accrual basis fiscal situation. Frankly, it falls on a lot of deaf ears. And so the fact of the matter is that we've tried to figure out another way to get at that. And we have been a supporter of this resolution that would require the members of Congress to receive this report in much more detail, to have to focus on this report. And when you look at the accrual basis financial statement, it's not a pretty sight. When you take in the footnote items that are sort of the unfunded and not required to be on the balance sheet obligations, predominantly in some of the Medicare and health cost issues, the actual accumulated deficit of the government is in excess of $100 trillion on an accrual basis. That's a big number. Mm-hmm. And as a trade-off in voting this continuing funding of the government, there is a commitment to bring to the floor the vote, particularly in the House, to vote on this resolution. And it probably will take place in the next couple of weeks. That will require the two respective budget committees to have this type of presentation where the entire members of Congress are privy to or part of it, not just the committee members. And we think that it's a small step forward, but awareness and profile of these types of issues is a really, really important first step. And it's something that, as I said, we've been working on as a profession for several years. It looks like it will move forward. And it's interesting that some of the members who were sensitive to voting on the continuing funding of government have sort of rallied around this particular issue. There are 80 co-sponsors, bipartisan in the House and the Senate, that are in favor of this particular resolution. And now it looks like it will be brought forward, likely to be passed, and then it will become the standard operating procedure of the Congress to receive this annual audited financial report that shows the total picture of the federal government on an annual basis. Hopefully that then produces more strategic planning, more long-range planning as to how, in fact, as a citizenry, as a country, that we actually pay for all of these things.
Well, Barry, there's a lot of comments coming in around these accrual-based, financial statements and the importance of it. So we'll share more about this in future town halls. In this slide here, a lot of profession hot topics. I know we'll be getting more into this in future sessions, more about tax planning, more about some of the M&A activity that's occurring in the profession. Maybe bring an expert on to discuss that. And we'll continue to talk about the big talent issue, which is just economy-wide, not just from a profession standpoint.
And, so and real quick, the big takeaway there, Eric, is it's been tough 2 tax seasons. We're at sort of the proverbial end on October 15th around the corner, and now we got all this tax planning we've been talking about. So it's the fatigue point. We're very sensitive to that, but we're clearly into that notion. Yeah. So let's move on to the DOL.
There we go. We got 7,000 attendees, Barry. So I know this is a quick update you want to provide them.
Yeah, I really want to make everyone aware of this, and we've been talking about this broadly. The Department of Labor, the United States Department of Labor, has every 8 to 10 years for several decades now conducted a quality study of audits of employee benefit plans. And as many of you know, we have an audit quality center that's focused on employee benefit plan auditing. And we've done a lot of work over the last 6 or 7 years to really elevate the quality by all firms that are in this area, that are a real focused element. It's been a key component for a long time. And in tribute to the men and women in the firms that are represented on these calls, we believe there's a lot of ample evidence that the quality has, in fact, really been a top priority of firms and has moved in this last go around. But this 8 to 10 year cycle is upon us. And we have a great working relationship with the DOL. We both, are aligned as to really making sure that these plans are done on a quality basis. And the DOL is ready to commence its sort of study again, this 8 to 10 year study. It will be for entities, employee benefit plans, that the reports are being finished. October 15, 2021 is the due date, the extended due date for most of these. And it's basically the 2011, I'm sorry, not the 2011, the 2020 engagements that are being finished in 2021. Now, the DOL is very sensitive to what all firms have been through, just the layering of all of these activities, the tax work, the COVID environment, et cetera. And I think it's a tribute to the DOL and our team working with the DOL. But this study will go forward. They are actually being very cooperative on the timing. So the request for this information is going to fall later in the year, after Thanksgiving, sort of between Thanksgiving and Christmas, the bulk of this. There are going to be some statistical sample that goes out of about 300 to 400 audits. If you do audits in this space, you could be randomly selected. There will be some very detailed requests for information to document the quality of the audit. The firms will have sort of one shot to submit that, and that will take place, before tax season ramps up a bit, big time again, which will be in January. And then they'll do the work during tax season and, the summer. And then later in 2022, firms will get the results of that, and we'll get the results of the overall study in that environment. So they're showing, I think, a deference to the busy seasons of firms to try to slot that in. And we're just making everybody aware of it. It's the engagements you're working on now. You could be randomly selected. Cooperation is essential. And obviously, if you have a particular problem or something, we're here to help you with that.
Okay, well, an important activity. So thanks for that update, Barry. We're now, we'll be bringing you back up for open forum. And Lisa Simpson will be joining now. And Lisa, I know you've got a great update, and everybody missed you last week, and I think you've got a lot of gold to share with them. So let's get right into it.
Absolutely. So I've noticed in the past that there's been some confusion about acronyms. So here's your glossary of the terms that we're going to use as we move forward. And we're going to start by just taking a fast look at where PPP forgiveness stands now. So the SBA is updating their statistics a little more regularly. So you'll see that we're making progress. Through September 12th, you had PPP volumes forgiven $530 billion. There's still a lot outstanding, but in terms of where we are in the process, the 2020 loans are coming in, still some delays in some of them, and we'll talk about that, but it is moving. Overall, if you combine 2020 and 2021, 63% of the loans have submitted forgiveness applications. They are going very quickly through the direct forgiveness portal that the SBA created in August. And we've talked about that in the past. That's moving very smoothly. If that's not what you're hearing, why don't you put that in the comments for us so that we know, because everything that we're hearing is that's moving quick. If you are working with your borrowers on their forgiveness loans, we'd suggest that you prioritize those 2020 ones because payments are due. They're at the end of their 10-month deferral period, and payments are coming due soon. Or if you've got a borrower who's looking to do a change in ownership, you'd want that cleared up by the time of the transaction. So good news there.
And Lisa, I just say two things. I mean, I think what we're hearing from a lot of firms is overall this experience with their clients is going rather well now. I mean, the firms are not under the time pressure that they were under to get the application in, which is a positive. And secondly, both the lender portals into the SBA and the SBA Direct are working. So both paths are good. It's not that one path's more preferred than the other. It's really the lender that's making a decision. But what we're also hearing from firms, a lot of the clients are just having a more positive experience with the firm around this, and there's just more discussions about their overall business activities. So I think it's another good trusted advisor moment.
And here's some great data to show that things are going well, because if you look at the overall loan forgiveness rate through just a few days ago, we're still at over 99%. So those who've applied for forgiveness, 99% of the loan is getting forgiven. So we do expect that we'll see a ramp up in volume between now and the end of the year. You guys are making it through the home stretch on tax filing season. A lot of borrowers might want to get this off the books by the end of the year. So lenders are getting ready for another push at forgiveness. All right, so here's a hot topic that we wanted to talk about today. And we've been letting the lenders and the SBA know that a lot of the delay in filing is because we've asked you to really consider how PPP and ERC interplay. So as a reminder, we got a notice a while ago where the IRS gave very specific examples that basically said, if you have claimed wages on your PPP forgiveness application they are not eligible for forgiveness in ERC. There are some nuances around that. That's not what we're going to cover today. We've done the past town halls, and you've got the notice to refer to with very clear examples. But basically, what we want to try to talk about today is how to maximize that. So maximize by using your non-payroll costs up to that, so that you've still maintained 60% threshold for payroll, but that gives you 40% of non-payroll that you can use. And so let's look at some conversations that I've been having with the SBA around that topic. So what we asked, so we waited for IRS guidance for a while, right? And when that came out, on the next slide, we did not get the guidance that specifically related to how to allocate wages between PPP and ERC. So then we started thinking about it, and it's like, well, that's not really, that the SBA is the one who needs to say that you've got flexibility in how to allocate wages between PPP and ERC. So you've got that overall rule, you can't double dip, but the question really is, do PPP funds have to be used on a linear basis, starting with the date of the covered period, or can a borrower allocate payroll on a per pay period per employee basis between PPP and ERC, up to, considering all of the factors, that all the limitations and all of that kind of stuff. And basically the SBA said there's nothing that prohibits that. So if you've got a PPP borrower who is eligible for ERC, you're able to maximize those two programs by picking and choosing what funds you want to allocate to which program. So that's great news. So I thought we'd go through a quick example, and we'll show that on the next slide. So here's my example. April 1 loan date. I'm choosing a 24-week covered period because I want to maximize the amount of compensation per employee that's eligible per PPP, because that's free money. That's a grant. My loan amount's $125. I've estimated that I've got about $40,000 in non-payroll costs that I'm going to be able to utilize. So again, I want to maximize the payroll that I can allocate to ERC, but keep my 60% threshold for PPP. So I know that I'm going to use an example where they're not employees, or they're not owners, excuse me. So their maximum eligible compensation is $46,154. I chose a pay frequency of weekly, and yes, they are eligible for ERC in Q1 and Q2 of 2021. So what does that look like? Again, I had to bring out my eye chart, and I had to bring out another favorite sitcom. So I have shown you one way to do this. And this is simplified. We're not getting into all of the details of what's eligible for ERC compensation versus PPP compensation. We're just going to keep this one pretty straightforward, so you see the theory, and then you can apply this to your clients in terms of the details applicable to their situation. So I did mine on a weekly basis, just to have a clear path of the logic that I'm using in this example. I think that you can do this on a quarterly basis. Obviously, I've got 3 employees. It's pretty simple to do weekly. If you've got 500 employees, you might want to look at it on a quarterly basis. But again, let's just talk about the theory right now, and then you can adapt the theory to your circumstance. So I've been talking with firms about this. Several firms have already been doing it this way. Several firms have been saying, let's just hold off and see what kind of guidance we get. So they were just waiting. I do not have a written response from the SBA. This was in a phone conversation with staffers at the SBA. So hopefully that'll give you some comfort. But again, I can't find anything that prohibits it. They don't see anything that prohibits it. So we think it's the path forward. So if we look at this spreadsheet and the way I've done it, basically I've allocated wages and health insurance, because health insurance is treated differently for ERC than PPP, and well, other benefits are treated differently for PPP and ERC. So I broke out health, lumped all of my other benefits. Again, these are not owner employees, so I have none of that to deal with. And I'm just simply allocating what's ERC first because it's April. So I want to get my quarterly max for each employee. And then I'm going to allocate the rest to PPP. And then I just go through this process week by week by week. So on the next slide, I get to the end of the quarter. And at the end of the quarter, you can see that I've maximized my PPP, my ERC wages and benefits for David, Alexis, and Ronnie. So I've got $30,000 of wages for ERC for Q1. The rest I'm going to allocate to PPP. Then my quarter starts over on July 1, and I get to start picking and allocating again. So again, this is a week by week basis. You can do it quarter by quarter. You can, adapt this theory to whatever works for yours or your client situation. But hopefully it'll be helpful in getting through that hurdle of not wanting to apply for forgiveness for PPP because you haven't figured out how ERC will work. So you've got maximum flexibility there, which is a huge win in my opinion. So hopefully that's helpful. Quick hits on a couple of other business relief programs. SVOG, just keeping you in the loop on that. You've got new data. They've begun issuing supplemental awards to eligible recipients. We talked about the requirements for that a couple of weeks ago. Those are going out the door. They've issued 16,000 grants. It's 11 billion, but there's still 16 billion available. Total available. So 5 billion left. There are about 5,000 applicants who are suing the SBA because they were denied and they don't know why. So some more to come on that. Next week, we'll have an accounting for SVOG and RRF video for you. So Carrie Hipsick will be on for me next week and she'll talk to you about that. Quickly on the COVID-19 EIDL program. And I'm seeing some questions in the Q&A around EIDL. It's a complicated loan structure. But what we'll talk about today are some of the changes that they've made to the program. They've re-upped the limit from 500,000 to 2 million. They've loosened up some of the ways that you can use those loan proceeds. They've extended the deferral period. They've made the affiliation requirements simpler. Basically, the SBA is looking to COVID EIDL as a way to help those really hard-hit industries like restaurants, retail, gyms and things like that maybe used up all of their RRF or didn't get an RRF, who might still need access to capital to keep them going. So I've given you a link to the IFR on those details. There's a great Journal of Accountancy article that you'll see in the header. That's the link to that. And we'll be discussing EIDL in more detail in the future because again, it's a fairly complicated loan structure. So we want to bring in some experts for you.
Well, Lisa, I'll say that I've been watching only 300 questions and growing here today on today's town hall, but a lot of thank yous related to your ERC and PPP interplay.
Good.
Some people thanking you for getting this clear answer. Others saying this is what they've been doing and now they can sleep better at night.
Perfect. That's
Good.
great. That's what I wanted.
Yes, well done, well done. And with that, we've got some time here for some open forum discussion. Lots of questions coming in. I'll grab one, Lisa, for you, just kind of continuing the ERC. People saying, and maybe you want to talk about, some of the issue that some firms are feeling with their clients and the delay in getting that ERC refund. But just can they amend ERC now? They're learning, new information. The amending of an ERC return.
Yep, you do have the ability to amend a 941X again, so that should be an option for you. But the pain around ERC, in addition to how long it's taken to get some of the guidance and clarity, some of the issues around owners and related employees not being eligible for ERC, a lot of the pain is around how long it's taking to get those refunds. If you filed a paper 941X, we're hearing that it's taking months and months and months because those returns are going into the IRS backlog.
That's frustrating. Another question just on, some people who've been paying attention to legislation in the infrastructure bill about the ERC ending as of today. So Barry, Lisa, that's right now, 2 to be determined, correct?
To be determined, but it is an infrastructure bill to end it. And, it's one of those things, Lisa just commented on the backlog. One of the arguments is, well, people aren't really using it. Well, people really aren't using it because it's not getting processed. So, I mean, it's one of those circular government arguments in certain changes, but it is, if the infrastructure bill becomes law, it does look like it ends September 30th.
We just received here from the questions, the House passed the funding bill. So real-time feedback from our audience. Tim, as you listening to the discussion, anything else that you would like to add? And I know you also saw what the AICPA is trying to do related to getting those financial statements reviewed, the U.S. financial statements. I know that's something that you're also passionate about. Is how is all this going to get paid for?
Right. Well, there are, and only because there's just a lot here. If I can just mention a couple of things. Here's some surprising proposals, and I want to come back to any specific questions that were not included in the current legislation. There's no elimination of basis step up for a decedent, so that's still fine. There's no income tax on unrealized gain at death. And further, S corporations that want to convert to a partnership, no tax events. So again, just some more ideas. This is a very unusual bill because it has some very popular techniques that they didn't strike, and even in certain ways reaffirm them. So again, it's a very business friendly provision and a bill generally.
Except maybe with the minimum tax point.
Well, yes, but the minimum tax has been around, and I won't tell you the story about a particular president who imposed the alternative minimum tax because there were 6 people in the state of Texas that were not paying tax.
Yeah, in this case, though, I think it's a small business versus big business issue, and
right.
The definition of what is financial statement income or book income becomes very dicey on where this 15% tax, if it becomes enacted, sort of sits. I think I think when you're dealing with small business clients, depending on their income levels and that, it can be a dicey issue when they may have a tax loss and that minimum tax kicks in now. And I know the concept has been around for a while, but hitting it at the corporate level is going to be new for a lot of entrepreneurs right now.
Mm-hmm. Right.
But
we didn't talk about
in the end, but it could get in, is I guess the key point. Not technically in, but could get in.
Yeah. We didn't talk about executive compensation today, but there's also things to consider there. Maybe we can do another round or another presentation at some point.
So yes, a couple of questions here. One, Lisa, one for you on. So the EOC, I mean, if it does end 9/30, does that impact being able to use it for Q3?
I wouldn't think so, because you'll still be able to file that 941 X at some point. So it's not like the funding goes away. You just can't use it for wages after 9/30.
Right. Barry, IRS service level, some just a bunch of points coming in related to that. We had a very good discussion. I know you were aware of last week. Anything you'd like to add there?
Look, the service levels are a problem. I mean, the backlog that Lisa was talking about on ERC is a component of those service levels, right? The amended 941s, et cetera. I think it's frankly not getting better. I mentioned there is some funding in the bill. Some of the problem is clearly technology. That's a long run solution. We have been in favor of sort of a clean slate on some of these penalty aspects related to COVID. That would reduce a lot of the correspondence in the backlog that's been going on. That's a hard thing to pass on an individual basis, but we hope that the support for it, constituents calling their members of Congress or complaining about these services, will lead to the pressure to be brought to the IRS to really address this particular issue. The IRS could do that approach on the penalty and solve a lot of the backdrop or a lot of the backlog that exists, and that would give a lot of freedom in that process. But I wish I had better news for you. It is something that is at the top of our agenda. I've said this before. Look, the men and women of the IRS are not trying to do bad service by design, but it is a bad service situation that is there, and unfortunately, there's not an easy path out of this situation.
Tim, some questions coming up just on what you said about the current bill and the step up in basis upon death being in effect or not in effect, and unrealized gains.
Right. The bill in its current form doesn't impose any tax. Those provisions are still, as have been, perfectly appropriate and allowable.
And it doesn't seem to be a lot of traction on that particular point. I mean, again, anything can happen, but what Tim is saying, the step-up basis, doesn't seem to be part of the negotiation process and things of that nature. There is some noise in the system on the carried interest issue, but the stepped-up basis point seems to not be getting any traction.
All right.
Tim, at Eisner Amp or ERC, I mean, is there any, as you've heard this discussion, a lot of questions coming in. Is that something that you're involved with there?
Yes, we formed a team task force. It seems so long ago now, but I guess the spring, am I correct? The spring of 2021. We were busy all summer, and it has not been as busy, but we're still very much engaged in that. And I was going to mention another item on the Supreme Court. Remember the net investment income tax last summer? There were some rumors floating around, and we did a lot of protective refund claims on that. I would only remind everyone, our CPA friends and so forth, that that's something that could come back. I mean, being aware of how you could file protective refund claims in many scenarios. And I'm just remembering that, Eric, because last summer, there was the ability to file protective refund claims if the Supreme Court had ruled that was unconstitutional.
Well, thanks, Tim. Barry, maybe just one concluding summary comment from you as you look at this. I mean, today we got into, and we'll be unpacking what happens with this legislation for quite a while. We'll have the town halls talk about it, but the AICPA will be putting on technical webcasts that will expand on many of the points that you and Tim raised. So as you think about this is historic. I mean, this is another historic tax change. You've seen a lot of these. So how do you look at this? Because we're numb in some ways to $7 trillion in business relief last year. Now we've got a few trillion here, but I think it's important for you to keep this in perspective for all of us.
Yeah, and inevitably tax law changes are about social issues, right? I mean, the tax law per se is a revenue raising piece of legislation, but tax law drives significantly certain policy debates, et cetera. And we have such a divided government today. And I did mention there's probably a little bit more bipartisanship than the media ever reports on. But, we do have polarized electorates and polarized districts and polarized members of Congress. And frankly, some pretty interesting races in the House that's going to be coming up in now, basically races a year from now. And so I think it's inevitable that these legislative issues really play out on sort of the social debates that are out there. Elections do matter, to quote a former president, in these types of environments. You could see just, the Senate is 50-50, the tie is broken by the vice president. But if it was 51-49, say R to D, the whole debate around a lot of these issues would be totally different. Just one switch of a Senate seat. The House, history would say there's a good chance that will change. And so for those of you doing the planning purposes and stuff, it gets to be a very, very complicated element. And it is a manifestation of the social issues of our country, which have become, with social media and the like, much more prevalent as far as the debate goes about from a tax perspective. And we haven't even talked about the international aspects, because when we have the pay-fors in this environment, as it relates to, the funding of the infrastructure bill and the budget bill. International taxation is going to be a big part of that as well. It's almost the last piece that sort of solves the mathematical problem. I would just say that, it's just going to be, it's an opportunity to do great trusted advisory planning work with clients, but it's going to be complicated as well.
Great conclusion there. So people are asking all about Town Hall. They're all available. Today's Town Hall will be available in about an hour on AICPA TV, YouTube. So leverage it. All the resources that Lisa just covered today are being added to the PCPS Resource Center. There's additional ERC resources that you can access via these links. And we will be back with you next week, October 7th. We're really, we've had some adjustments due to holidays and tax deadlines, but we're really going to try to bring the town hall to you twice a month. We will have a special edition if we need to, like we did last week. So we really appreciate being with you, especially on a dynamic day like today. Your questions are helpful. So hopefully today's session was helpful. Barry, thank you. Tim, thank you. And Lisa, thank you. So hope you all have a good end of the week, and we'll see you soon.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.